On July 1st, 2025, the global banking system officially killed paper gold. The Basel III Endgame went live. Allocated physical gold was reclassified as a Tier 1 high-quality liquid asset with a 0% risk weight. The regulators put it on equal footing with cash, which means the world's central banks just declared that real gold is the only gold. You see, most people believe their gold ETF or unallocated bank account is as good as gold. It's a lie. You don't own gold. You own a bank's promise to maybe give you gold if they don't go insolvent first. Today, I'm breaking down the three-stage legal trap that's turning paper gold into a bankruptcy asset, while physical gold is about to break $5,000 per ounce by the end of 2026. Stage 1 is the regulatory kill shot. Stage 2 is the legal seizure mechanism. Stage 3 is the price divergence that bankrupts the paper holders, a mandatory protocol before we open the file. This is not financial advice. I'm not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. The trap started with a single ratio, the net stable funding ratio. You see, regulators slapped an 85% required stable funding penalty on unallocated gold. This is the paper gold sitting in your ETF, the digital claim in your brokerage account, which means for every dollar of paper gold on their balance sheet, banks must now hold 85 cents in cold, hard cash. This is not a suggestion. This is Basel III enforcement. The compliance deadline was July 1st, 2025. The banks had no choice. Plus, this penalty does not exist for allocated physical gold. If the bank holds the actual bar in an allocated vault with your name on the serial number, the required stable funding ratio is 0. The regulators are telling the banks exactly what to do. Dump the paper and hoard the physical. The free lunch is over. You see, for decades, banks ran a leveraged game. They sold paper claims against a fraction of the real metal. Some estimates place the paper-to-physical ratio at 400 to 1, 400 paper contracts for every single ounce of real gold in the vault. That system worked as long as regulators allowed banks to treat paper gold as a stable asset. But Basel III Endgame killed that classification. Paper gold is now Tier 3. It's a toxic liability, which means the banks are dumping these contracts onto retail investors while quietly accumulating the physical bars for themselves. The math is surgical. If a bank holds $10 billion in unallocated gold exposure, they now need $8.5 billion in cash reserves just to comply with the NSFR. That cash could be deployed into loans, bonds, or equity. Instead, it's locked as a regulatory penalty. The incentive structure is clear. Exit paper gold immediately. Plus, the banks are not advertising this. They're not sending you an email that says, your gold ETF is now classified as a high-risk liability under Basel III. They're quietly unwinding their exposure and leaving retail holders with the bag. You see, when the next liquidity crisis hits in 2026, those paper contracts will be the first asset class the banks sacrifice. They will suspend redemptions. They will cite extraordinary market conditions. And your digital gold will vanish into the legal void while the physical bars remain locked in the vaults of the same institutions that sold you the paper. If this regulatory kill shot just clicked for you, or you want to track these Basel III mechanisms as they unfold in real time, join the Forensic Circle by hitting subscribe. We hold ourselves to a different standard here. The NSFR penalty is the surface, but even this regulatory chokehold is a distraction from the deeper legal trap hidden in the fine print of your brokerage agreement. Because when the 2026 liquidity freeze begins, the banks won't just stop honoring your paper gold, they will legally seize it, and the law that allows them to do this has been on the books since 1994. That mechanism is in Stage 2.
The law is called the Uniform Commercial Code, Article 8. It was written in 1994. It governs investment securities in the United States. And buried in its definitions is the mechanism that will legally erase your digital gold when the banks need liquidity. You see, when you buy gold through an ETF or hold it in an unallocated account, you do not own gold. You own something called a security entitlement. This is not a metaphor. This is the exact legal term under UCC Article 8, Section 501. A security entitlement is a contractual claim against a financial intermediary. The intermediary is the bank or the brokerage. You are the entitlement holder. The gold itself is held in a pooled account that you do not control, which means the gold is not your private property. It is the bank's collateral. Plus, under UCC Article 8, Section 503, your claim to that gold is subordinate to the claims of the financial intermediary's secured creditors. Let me translate that. If the bank faces insolvency, the people who loan money to the bank get paid first. You are an unsecured creditor. You are last in line. The hierarchy is mathematical. Secured creditors, then operational obligations, then regulatory capital requirements, then you. You see, this legal structure was embedded into the system during the derivatives boom of the 1990s. The banks needed a framework that allowed them to rehypothecate assets. That means using the same asset as collateral for multiple loans. Your gold ETF share represents a claim on gold that the bank has already pledged to 3 other counterparties, which means when the liquidity freeze hits, the gold you think you own will be seized to satisfy the bank's obligations to its senior creditors, and it will happen legally. The script has been tested. In March of 2023, Credit Suisse collapsed. Swiss regulators invoked emergency powers and wiped out $17 billion in additional Tier 1 bonds to facilitate the merger with UBS. The bondholders were told their claims were subordinate to the systemic stability of the banking system. They lost everything overnight. You see, the same legal logic applies to your security entitlement under UCC Article 8. In a crisis, your digital gold is not protected property. It is a liability on the bank's balance sheet that can be sacrificed to preserve the institution. The Dodd-Frank Act, Title II, codified this into U.S. law in 2010. It created the Orderly Liquidation Authority. This is the mechanism that allows regulators to seize and restructure a failing bank without a formal bankruptcy, which means the bank does not need to go through court proceedings. The Federal Deposit Insurance Corporation steps in, freezes the balance sheet, and reallocates assets to stabilize the system. Your security entitlement is not exempt. It is classified as an unsecured claim. You will receive a notice that your gold holdings have been converted into equity in the restructured bank or a cash settlement based on the distressed market price at the time of seizure. Plus, that cash settlement will not be the spot price of gold. It will be the value of your paper contract at the moment of maximum panic. When gold is trading at $5,000 per ounce, your paper claim might be settled at $2,000. The legal fine print is airtight. You cannot sue for the difference because you never owned the gold. You owned a security entitlement, and that entitlement was always subject to the terms of UCC Article 8. UCC Article 8 makes a distinction that most people never read. A certificated security is a physical document or asset that you hold directly. If you own a gold bar with a serial number registered in your name, stored in an allocated vault where you control access, that is a certificated security. It is private property. It cannot be legally seized without due process. But a security entitlement is different. It is an indirect holding. The bank holds the asset. You hold a claim on the bank's promise, which means the moment the bank enters distress, your claim evaporates. You see, this is why the Basel III Endgame was designed the way it was. The regulators are forcing the banks to distinguish between real gold and paper gold. The banks are responding by hoarding the real and dumping the paper. They know what is coming. While the paper market is being bankrupted by regulation, physical gold is decoupling. Central banks have entered what analysts are calling a supercycle of accumulation. Since 2022, global central banks have been buying over 1,000 tons of gold annually. This is the highest sustained purchasing rate in 50 years. As of the end of 2024, central banks hold 36,200 tons of gold globally. That accounts for 20% of all official reserves. You see, they are not buying paper contracts. They are demanding physical delivery, allocated bars, serial numbers, vault audits, which means the physical supply is being drained from the market at the exact moment that retail investors are being sold paper claims against a shrinking pool of real metal. The math is breaking. J.P. Morgan released a forecast in November of 2024. They project gold will hit $5,055 per ounce by the fourth quarter of 2026. Goldman Sachs went further. They modeled a scenario where physical gold reaches $5,400 per ounce if the paper market collapses into backwardation. Backwardation is when the spot price of physical gold exceeds the futures price. It signals a supply crisis. It means people are willing to pay more for gold today than they are willing to pay for a promise of gold in 6 months. This has only happened 3 times in modern history: 1980, 2008, and briefly in 2020 during the pandemic lockdowns. But the 2026 backwardation will not be brief. It will be structural. You see, the Basel III NSFR penalty is forcing banks to exit their unallocated positions. That creates selling pressure on paper gold. At the same time, central banks are buying physical at record rates. That creates buying pressure on real gold. The two markets are splitting, which means by the end of 2026, you will see a two-tier pricing system: paper gold trading at a discount to physical, ETF shares suspended from redemption, and physical bars trading at premiums of 10 to 20% above spot. The people holding paper will be trapped. The people holding physical will control the only asset that central banks recognize as Tier 1 collateral. The timing is not random. 2026 is the year when $38 trillion in global debt reaches maturity. Commercial real estate loans, corporate bonds, sovereign debt rollovers. The refinancing wall is biblical. Plus, the Federal Reserve is projected to hold interest rates elevated through mid-2026 to suppress inflation from the fiscal deficits, which means the cost of refinancing that debt will be catastrophic. Defaults will cascade. Banks will face liquidity freezes. And when the liquidity freezes, the banks will invoke UCC Article 8. They will seize your security entitlements. They will convert your paper gold into cash settlements at distressed prices. And they will use the physical gold they hoarded during the Basel III transition to meet their Tier 1 capital requirements. You are the liquidity of last resort. The central banks know this. The regulators designed it. The banks are executing it. The only question is whether you understand the script before the curtain drops. But even this legal mechanism is only possible because of a pattern that has repeated itself across 3 empires. The same 7-stage script that collapsed Spain in the 1590s, Britain in the 1900s, and the Soviet Union in the 1990s. The United States is at stage 5, and the Basel III Endgame is not a random policy. It is the transition plan to stage 6. That historical pattern is stage 3. There is a pattern in history that has destroyed 3 global superpowers: the Spanish Empire in the 1590s, the British Empire in the 1900s, the Soviet Union in the 1990s. The script is identical. 7 stages. Mathematical. Inevitable. The United States is at stage 5. In 1571, Spain controlled the world's gold supply. The treasure fleets from the New World delivered 200 tons of gold and silver annually to the Spanish crown. No empire in history had ever commanded such wealth. But the gold did not stay in Spain. You see, King Philip II was fighting wars on 4 fronts: the Dutch revolt, the Ottoman Empire, the English privateers, the French succession crisis. Military overstretch required constant financing. The Spanish crown borrowed against future gold shipments to fund immediate wars, which means the gold belonged to creditors before it even arrived in Seville. In 1596, Philip II declared bankruptcy for the 3rd time. The debt had outpaced the gold. The creditors seized Spanish assets across Europe. The empire entered terminal decline. The empire controls global trade and issues the currency that other nations must hold. and they are. Since 2022, central bank gold purchases have surged to the highest levels in 50 years, over 1,000 tons annually. They are converting dollar reserves into physical gold because gold cannot be frozen by executive order. Plus, the BRICS nations, Brazil, Russia, India, China, and South Africa, announced plans in 2023 to develop an alternative trade settlement system. Not a single BRICS currency, but a gold-backed clearing mechanism that bypasses the dollar entirely. Which means by the end of 2026, the global reserve currency system will no longer be a dollar monopoly. The maturity wall is biblical. $38 trillion in global debt matures in 2026. Commercial real estate loans from the 2013 to 2016 boom. All of it comes due in a 12-month window. Plus, the Federal Reserve has signaled it will hold interest rates elevated through mid-2026 to suppress inflation. Most people will ignore the fine print of UCC Article 8 and pay the price. They'll hold their paper gold through the 2026 liquidity freeze and watch as ETF suspension notices arrive. They will only learn the difference between a security entitlement and actual ownership when the settlement checks arrive at 50 cents on the dollar. But if you refuse to be a victim of the next reset, you're in the right place. This channel is for forensic auditors, people who understand the system is designed exactly as intended. We read the Basel III amendments, track central bank gold flows, and decode the legal fine print that determines who survives and who becomes collateral. The world isn't running out of gold. It's running out of real gold. If you're committed to this standard, subscribe now and join us. The file is closed.